as Canadians, what we could look at doing, is having an LLC in the US, and then a corporation, for example, could own that LLC. So a Canadian corporation could own the US LLC. At that point, that's when your business structure starts to get a little bit more complicated. And there's a lot more to consider with that. So that's where we would want to have a bigger conversation about what that means, about what the purpose of it is, and if it's going to give you a benefit. But just be aware that that is an option. So now let's touch on the tax rates in the US for a little bit here. I've been talking a lot about the marginal tax rates, your personal marginal tax rates, but what exactly does that mean? So in Canada, we know our tax rates are fairly high. In the US, as we can see here, they're much lower. Again, note these are only the federal tax rates. We'll talk about state tax rates in a little minute or in a couple minutes here. I'm not going to go through every line. I'll let you kind of take a look at this table for yourself, but just note the highest tax bracket here is at 37%, and that tax bracket for 2024 starts at about $609,000. So it's quite a difference from in Canada here. So when we're talking about flow-through entities, when we're talking about LLCs and the income flowing directly to your personal tax return, these are the tax rates that you'll be paying at, depending on where your income lands. As a Canadian citizen, your US income is the only income that will be reported in the US. So whatever your rental income is, that will likely be the only income that's being taxed in the US. So you could figure out your tax bracket accordingly. Now we'll look at the state tax rates, and these are can be a little bit more complicated depending on the state that you're in. Some states don't have any state income taxes, which is great for an investor. Some states do, but they only tax certain types of income. Certain states only tax interest income, some tax interest and dividends, others tax only capital gains. So what's important for you to note here is when you're looking at investing in the US in real estate, make sure you do your homework on the state that you're investing in. Does the state have state taxes? If so, does the state have income taxes or capital gains taxes? These are some of the questions that you'll need to ask yourself when you're looking at properties and when you're trying to decide which state to invest in. So now we'll talk a little bit about the tax filing and how that works. So now you have, let's assume you've gone with an LLC in the US, you have your rental property, you have income coming in. How do we treat this? So first, this income, it's US sourced income, it will be reported and taxed in the US first. You would file a 1040 or a 1040 NR for a non-resident. This is just a personal tax return in the US. This is the name of the form. If you have a corporation, you might have to fill out an 1120. Again, for our purposes, we're not going to jump into that too much now. We'll just focus on the personal side, the 1040. So, and you'd report that income in the US and you'd pay tax in the US on that. Assuming that you are a resident of Canada, however, the income still needs to be reported in Canada on your Canadian tax return. This is because as a Canadian resident, your worldwide income is taxed. And this is consistent as well. If you're a US resident, your worldwide income would be taxed in the US. So now a question I often get asked is, am I paying tax twice on my US income? Right? So if I pay tax in the US first, and if I pay tax in Canada, am I paying tax twice? And the short answer is no. You may pay tax in Canada as well, but you're not paying double tax. You're not being double taxed on it. So we can claim the taxes that were paid in the US as a foreign tax credit in Canada. And an oversimplified explanation of how that works is, let's say, for example, you pay taxes in the US at 10%. If your tax rate is 30% in Canada, you would claim the 10% of taxes that you paid in the US, and then you would have to pay the difference to CRA in Canada. So you'd be paying roughly 20%. Um, so we still have to pay, unfortunately, the Canadian tax rates, but you're not losing out. You're not paying tax twice in that income. Um, and that's an oversimplified explanation, but that should give some type of idea, that this is an option. You will still have to pay tax in Canada, but you're not being taxed twice on it. A few strategies that we can use to reduce the taxes that you're paying is the business structure, as we talked about. We might not want to incorporate in Canada because you'll have to pay taxes at that 50% rate. So evaluating your needs and picking the right business structure can help in reducing your tax. Um, Depreciation. So this is a strategy that can be used to reduce your tax liability. We're essentially claiming the cost of the building as an expense over the life of the building. And in the US, they have a very good option. It's called a cost segregation study. So what we can do with that is if you get this study done, we can classify your investment. We can classify your real estate property differently depending on what the study tells us. So this essentially lets us claim a different rate of depreciation and claim more depreciation in the first couple of years. This would give us a bigger benefit upfront and reduce your tax bill earlier, so then you can start cash flowing the property. The US also has asset exchanges. So if you sell a property in the US and you buy a similar property, we can classify that as an asset exchange rather than a sale. So this is an area, again, there's a lot of details that we need to look at, but an exchange of this nature can help us avoid paying capital gains taxes. So rather than selling a property, recognizing a gain, and buying a new property, if both properties are similar and if they meet certain criteria, we can do an exchange. So it's a sale and a purchase with no capital gains. Obviously, there's some risk involved, right? So if you're investing in real estate, if you're investing in a business, there will always be some risk. As a Canadian investing in the US, there will be a higher level of risk. There's a number of reasons that cause this rather. The first is whenever you report foreign income and foreign taxes in Canada, you're more likely to be reviewed. There's many reasons for this. CRA cannot verify any foreign taxes on their own, so they like to review it to make sure that it's accurate. This review, going back to the bookkeeping that we talked about, if you're keeping proper records, if you're keeping all of the information that is required, and I always help my clients with this, I always talk to them about these risks ahead of time so that when they get the proper information, when they get letters from the IRS, they're holding on to them. So if they get this review, we can easily respond to it and then there's no issues from it. However, these reviews can cause significant problems. So if the review is not responded to properly, CRA can actually remove the foreign tax credit from your tax return. And I've seen situations where clients have owed, $100,000, $140,000 to CRA because these letters were not responded to. It's something that we can fix. So in the long run, we ended up getting that situation fixed for that particular client. So it was fixable, but again, it is a risk and it is something that you need to be careful of. Make sure you're keeping proper documentation so we can respond to these reviews. With investing across the border, there's just going to be added complexities. This creates inherent compliance risk. So if you have LLCs, if you have corporations, if you have partnerships, there are more forms to fill out. There are more tax returns to fill out. And with all of these forms and returns, there's more risk that if it's not done accurately, there could be penalties, there could be interest, things like that. So that's why we always strongly recommend work with a team, work with advisors. And when you're working with these individuals, make sure you plan with them ahead of time. So it's always easier for your team to create a plan, and then for you to go and implement that plan rather than for you to just go and do something and then try and go backwards, try and work backwards. So when investing in the US, as I mentioned, there is risk. There will be a risk. That risk can be mitigated, but it has to be planned. You have to create a plan to mitigate that risk. Um, so again, work with your advisors, work with your team, to make sure that you're aware of the compliant risk and that you're protecting yourself from it. Naturally, there will be foreign exchange risk. So with the currency, it can be volatile from time to time. Once you get established, this risk is a little bit lower because you will be cash flowing. Once you're cash flowing, you're not dealing with the exchange as much. As a matter of fact, you can actually capitalize on the exchange. Excuse me. You can capitalize on the exchange by using it to your advantage. But as you get started, as you enter the market, it is something to be mindful of. If you're putting Canadian dollars into US investments, your purchasing power with your Canadian dollar is much lower. So something to be aware of there. There is an increased liability risk in the US too. We briefly touched on this earlier. In the US, there's a higher chance of being sued. There's a higher liability, healthcare costs are higher if something happens that you're liable for. So this is something that you need to be aware of, and that comes back to our business structures again. Creating the proper plan, picking the proper structure to reduce these risks for yourself. And finally, FAPI, foreign accrual property income. So I'm not going to get too far into this one. This gets a little bit more complicated, but the idea with this is that if you are sheltering money, if you're sheltering your investments in a US corporation and you are deferring taxes on your passive income and you're trying to avoid paying tax in Canada on that income, CRA can actually assess you on that income and make you pay tax on the income, even if you haven't received it. So again, that's something to be mindful of. It's something to talk to your team of advisors about if you start to get into LLCs and corporations and different business structures. Be aware that FAPI is something that you should be asking questions about. So a quick overview here. I know I went through that fairly quickly. I want to leave enough time for questions. But investing in the US can create several risks that must be considered. So these risks can be reduced, but there is risk, right? At the end of the day, there is risk. And that's why you need to lean on people around you, lean on people like Ray, who have invested in the US, he's opened up many properties. He knows the risks. He knows how to use an LLC to mitigate some of those risks. Your US rental income will be taxed in Canada as well, but it's not subject to double taxation. So that's something you have to be mindful of too, right? Is if your rental income is flowing through to you and you are recognizing that as income, it will be taxed in Canada, and that's something you have to plan for. You need to plan to pay for those taxes. And again, we have that foreign tax credit that we can claim. We have depreciation that we can claim to reduce the tax liability. But if you are recognizing income, you need to be ready for the tax bill. And finally, talk to your team of advisors. Talk to Ray. He knows how to, like I said, utilize an LLC, how to structure things in the US to set yourself up for success. Talk to your accountant about the tax implications of what's going on here. Make sure you surround yourself with people that are experts in their field and can set you up for success. With that being said, please feel free to contact me with any questions. I'm happy to do a 15-minute discovery meeting free of charge with anyone who has any questions, anyone who would like to speak with me. The idea of the 15-minute discovery session is for us to get to know each other a little bit better and to determine what the next steps are. We may decide that you don't need help right now, but we'll then stay in touch as we move forward, as you move forward and look at properties in the US, and then we can talk about consulting at a later date.